Good morning, everyone. Welcome to our July monthly webinar. This month, as we do at the beginning of each quarter, we are going to provide you with an update on the investment markets and specifically what happened over the first 6 months of the year. It was certainly a wild start to 2025, and you may have noticed some fluctuations in your account values, particularly in April, and we'll dive into what happened and where we stand now. By way of introduction, my name is Micah Potashnik. My firm is 40W Advisors, and we have the privilege to serve as the advisors on your company's 401k plan. As part of our services, we provide financial education and resources to help you become more informed and better manage your personal finances. I'll talk more about some tools and resources here in a bit. Today, I'm joined by Jim Dowling from Fidelity Investments. Good morning, Jim. Thanks for joining us.
Thanks for having me. Excited to be here.
Great. Jim's going to do the heavy lifting today, but before I turn it over to him, a couple quick things from a housekeeping standpoint. This webinar is for educational purposes only and not meant as personal financial advice. Everybody is currently in listen-only mode, so please utilize the chat box, and I'll be monitoring that throughout the presentation. And with that, I will turn it over to Jim here.
Thanks, Micah. I appreciate that. Give me 1 second as I share my screen. Well, tremendous to be here. By way of quick background, my name is Jim Dowling. I work for Fidelity Investments. Fidelity is one of the largest asset managers and retirement providers in the marketplace. We're a privately held, family-owned company that's been in business since the early 40s. I'm one of those folks who has a very short resume. I've spent my entire career, over 20 years, at Fidelity Investments. And in my day-to-day interactions, I'm dealing with financial advisors like Micah and Chris and the folks at 40W and their clients and plan sponsors, and really trying to share what are our insights, what are our thoughts, what's Fidelity thinking out there in the marketplace and what's going on in the markets. And the goal today is do just that. There's an ancient Chinese, I guess it's almost a curse. It's not a kind of wishing you well. It's kind of may you live in interesting times. And I would say most folks would argue that we are certainly living in interesting times in regards to the world, the economy, and the markets as well from that perspective. One of the keys that we preach over the long term is really kind of not focus on the short term derivations in the market, the short term kind of ebbs and spikes, because it's impossible to time that. And I think 2025 is emblematic of that. And that's a theme that we're going to talk about, is kind of what went on in the market. Maybe you weren't paying attention and you didn't look at your account, you didn't look at the value, and you kind of clicked in on 6:30 of this year and you say, wow, the market overall is up about 6%. Kind of a nice start to the year. But when you go below the surface, it took a lot of work and a lot of change to kind of get us to that point. So first, we'll talk a little bit about kind of what we went through over the past 6 to 8 months, where we stand now, maybe our view of how we feel looking forward, and a couple key drivers or some interesting opportunities we're looking at from an investment perspective or an investment standpoint. So to go back about 6 or 8 months, Trump wins the election handedly, and we have this unbelievable market rally. The market has this poetic license to look forward. And what the market was seeing, and the market was really performing strongly in the fourth quarter and into the first quarter of this year, making record highs, was this platform of deregulation, fiscal stimulus, tax cuts, all the stuff that the market was saying would be good for the economy, good for businesses, good for the markets overall. Then all of a sudden, we started to hear this T word bandied about, right? Tariffs. And we had a little bit of a downdraft in the market in March. But the real key date was a date, April 2nd, which may live on in infamy, may not, which was Liberation Day, in which Trump came out and the administrative came out with a tremendous amount of tariffs. A market that was already feeling some stress and was already down really went into a tailspin at that point in time. Why? Because markets overall, investors overall, hate uncertainty. And love the administration or not love the administration, I think we'd probably all agree that oftentimes, at least with the tariffs, the process was a little bit of a ready, shoot, aim. So when we were talking to large companies, CEOs, CFOs of big companies, right? If you're going to make an investment of $100 million or $1 billion to open up a new plant, a new factory, to maybe invest overseas in a factory overseas, these Fortune 500 companies and large global companies, when you had no line of insight in what the expense or the cost of the tariffs were going to be, that made them really nervous, and it made the market nervous overall. In addition, we were in a point in time in which we're not even back to low normalized inflation rates. We're a little bit higher than normal. The market was also concerned that when you put an additional price on the stuff that you buy at Target or buy on Amazon of, I mean, heck, 100% tariff we're talked about with China, the market was very concerned that that was going to bring back and drive inflation. And when inflation is high, what the Fed has to do is try to stifle inflation, and they do so by rising interest rates, which we'll talk a little bit about in a second. So April 9th comes, and then all of a sudden, the administrator says they're not paying attention to the markets. You got to look at Chinese use a 100-year plan or whatever. But I think they were paying attention to the markets because on April 2nd or April 9th, I should say, we get this kind of 90-day pause. And the market starts to rally. And to give you kind of the numbers here, the market hit new all-time highs 50 days into the year, and then went down close to 20%, almost a bear market, down 20%, and then rallied back to make new highs, finishing out the quarter about up the broad market 6.5%. Now, I said earlier, the market has this poetic license in which it can look into the future and see into the future. It gets nervous when there's fog on the bridge, if you will. The other thing the market really can do is climb this wall of worry. And even though there was some stuff, some issues that the market was thinking about and facing, what we saw over the last month and 2 months and 3 months was the market really climbing a wall of worry. And what I mean by that is the lot of bad things out there didn't come to their full fruition. Geopolitical crises, which are still out there, unfortunately, have kind of tempered a little bit, and the market seems to see a path forward. The uncertainty that the tariffs would hurt economic growth continues to be strong. The U.S. market continues to be strong. The consumer seems to be strong. The concern that these tariffs were going to be pushed directly onto the consumer and hurt us in our wallets and our purses didn't really come to fruition as well. Then we started to get a little bit more good news or less bad news as well. Artificial intelligence, which is a theme that's been really driving the market, that story kind of felt like it was a little bit broken. It felt, for those of us who've been around for a while, kind of like this .com thing where the stocks went up and the stocks went down. Over the past month or two, that story has some legs, has some foundation to it, and we'll talk a little bit more and spend some time on it because it's driving a lot of the market. The other thing that happened, which has driven the market as well, is the tax bill, or the big beautiful bill as it's called, which is very stimulative to the economy and to growth passed. Also, when we check in on the consumer and we look at unemployment rates, we look at how folks are feeling from a personal wealth standpoint, how folks are feeling about stuff. The consumer, which is about 80% of the U.S. economy, has been really resilient. So when you bake that all in and you look at all that, we right now have a backdrop that is pretty good for a good stock market. Now, again, as I said earlier, the market's up 6 and change, almost over 7% as of last night. The market's got this poetic license where it can look forward and price in the good news going forward, which it's done. But I think the takeaway, again, is going into the market, everyone was like, oh my gosh, this is going to be unbelievable, very stimulative policies, the market rallies, and all of a sudden no one would have guessed that we saw a 20% downturn in the market. And again, as we all got pessimistic, the market rallies again to make new highs, which is very fascinating from that perspective. The thing I'm reminded of is when you're investing for retirement, you're investing in the market, you're investing in stocks. There's something you have to take here. Over the long term, the market does 10%. So if you invest in the market over the long term, historically, you'll get about a 10% rate of return. It's pretty tremendous when you start to think about it, because if you get a 10% rate of return, it means your money is doubling every 7 years. So when you're saving for retirement over the long term and you own stock mutual funds, stock ETFs and stocks, and if they're getting that 10% return, over time, your money should compound, right? As Warren Buffett said, one of the unbelievable magical things in the world is compound interest. Now, that doubling of the money every 7 years over the long term, to get that, it's an agreement to invest in the market. And what I mean by that is you have to tolerate what we went through this year, which is almost a 20% correction in the market. And if you sold out at the bottom, you locked in that 20% loss. The right-hand side says a 5% correction, you should get 3 of those per year. You should get historically 10% correction per year. You should get one correction of over 15% every 3 years, and then one over 20% correction over every 6 years. If you look at it on a year-by-year basis, right, you look at 2019, 2020, you go all the way back 100 years. We went back to 1936, so call it close to 90 years. If you look year by year, 75% of those years on a 1-year basis, you made money investing in stocks. 25%, 1 out of 4, you lost money in stocks. Now, I oftentimes hate to equate investing to gambling, but if you imagine for a second, there was a slot machine somewhere where if it paid out, you won, you pulled the wheel on the slot machine, and 75% of the time you won money in that slot machine. You would love to play that slot machine, but you wouldn't be able to because those odds are so good and so favorable of that payout 75% of the time that there would be a line miles, if not states long, to play that slot machine. And that's what we get with the market. It's being able to withstand what we saw this year, withstand that over the short term emotion, short term news kind of drives the market from that place, from that perspective. But over the long term, the market is very, very resilient. Oftentimes, too, as investors, as I said earlier, the safest route in our estimation is if you have a long-term time horizon, it is virtually impossible. The professional investors, no one can time the market. No one could found that bottom in April 9th and kind of got in at that point in time. Maybe there were people, but good luck getting back out of the market. What we've noticed, too, which I think is beneficial or positive for the markets overall, is that when we look at the amount of money that's been going into the market over the last 12 months, even though stocks are up tremendously over the last 12 months, most folks are still adverse, so risk adverse. Most of the money we're seeing is going into money markets. Again, I think it's a novel thing, right? We're actually making money on our money markets now after, 14, 15 years of zero interest rate environment. So we're seeing a lot of money going into money markets. We're also seeing a lot of money going into bonds, which we think bonds are a good value right now. They're paying a really good yield finally again. But the reason I bring this up is it's almost like an inverse relationship in which most folks are not putting money into the market. So when the question becomes, is this market overbought? Is everybody in the market like a 1999 or something like that? This is the most unloved market we've seen in quite some time from that perspective. And again, to kind of put a bow on this, I always try to focus on this. And I joked earlier, like, will Liberation Day live on in infamy? As you can see here, is, as I said earlier, this market has this unbelievable, undeniable ability to climb this wall of worry. And it does so year in and year out. And the name of the game is not to kind of focus in on these kind of short-term phenomenons. If you do have a long-term time horizon, stick with your guns. And I think this year, again, becomes an unbelievable proof point of if you got terrified of tariffs or what was going to go on and the world was going to end and you pulled out of the market after close to a 20% decline, you kind of lock in those losses, where in reality, over the long term, the U.S. economy is very resilient. U.S. businesses are tremendously resilient. And over time, they tend to grind higher, as I said earlier, a 10% rate of return over time. The big themes, like what has been really driving the market, there's a couple big themes, right? The first theme has been government policy, right? Probably more so than we've ever seen. The actions of the administration and the White House from an economic standpoint are really driving a lot of the stuff we're seeing in the market. The negative side of the policy side had been the tariff side, which caused tremendous consternation in the market, tremendous fog on the bridge, tremendous uncertainty for companies, for investors from that perspective. The other side, though, has been the big, beautiful tax bill, which is going to be very stimulative as well. So in the short term, the administration has definitely been driving a lot of the market returns that we've seen this year, and people trying to pay attention of what did Trump tweet, or what has he put out, or what is his statement going to be. And I think the market's starting to kind of handicap a little bit that a lot of it may be potentially bluster in the shorter term from that perspective. The other large theme, the big theme that we've been seeing driving the market has been the Magnificent Seven, or these FANG stocks. So think about Facebook, think about Apple, think about Alphabet, which is Google, think about Amazon, think about Netflix and Microsoft. The graph that I'm showing here, the green is the performance of the S&P 500 without those stocks in it. The blue there is showing the performance of those stocks into themselves. And there's a unifying theme, right? We've heard them called the FANG stocks or the FAN stocks or the Magnificent Seven. The unifying theme that we've really seen is artificial intelligence, meaning where we've gotten to from computer learning, meaning sounds a little scary, sounds a little sci-fi and futuristic, but machine learning and how this kind of plays out. From listening to some of our portfolio managers and folks who study the market, in my lifetime, my adult lifetime, there thus far have been 3 technological innovations that have dramatically changed my life and your life and all of our lives. The first one would be in the early 2000s with the advent of broad access to broadband internet, right? Imagine that. That was such an unbelievable change going from AOL dial-up or whatever the case may be to all of a sudden you have these pipes of broadband internet in businesses, in homes, in people's, and the ability to get information very quickly and share information. Unbelievable dramatic impact on all of our lives. The second innovation happened in Cupertino, California in 2007, which was the rollout of the iPhone. Again, all of a sudden, 2007, and since you're putting something that was the power of a desktop computer or a laptop computer in the palm of everyone's hands. And it was an unbelievable innovation that affected and transformed all of our lives and lives globally. The third one, which many of our folks are believing, is artificial intelligence. And if you want to point to the genesis of this, or the genesis of it coming really into our hands, would be on, I think it was November 30th, 2022, not too long ago, with the rollout of ChatGPT. I'm sure most of the folks on the phone have messed around with that, where you can say, hey, I want a vacation in Newport, Rhode Island, give me an itinerary. Unbelievable, powerful stuff. And that's just kind of one application of it. If you look on the left-hand side, what we view here is the amount of spending on artificial intelligence from an investment standpoint, from companies and people spending money on it, will grow over the next 5 years or the next 3 years at a 30% increase rate. So and basically going back to my other analogy, if you're growing at 30%, it doubles in about 2.5 years. ChatGPT can't be like underestimated, and just using that as kind of the example of it. The timeline and adoption of it is pretty unbelievable. The right-hand side just shows you the amount of time it took to get 100 million users. And if you look at Facebook, which seemed to kind of have an unbelievable growth rate, that took 4.5 years. Spotify, Netflix, 10 years, Airbnb, 8 years, kind of different models from that perspective. Instagram, 2.5, right? Had the kind of Facebook kind of tailwind from that perspective. ChatGPT to get there took 2 months. So really unbelievable growth. And what I would say is when you start to think about these artificial intelligence, these voice recognition, chat GPT type products, we don't know what the total impact is going to be, but we'll share with you some of the thoughts that we're thinking about. And I use the example of the iPhone, right? We didn't know what kind of disruption was that going to create for companies down the road. One prime example would be Uber, which debuted in Washington, D.C., where I live, in December of 2011, right? It seems like we've had it forever, but 2011 was when it rolled out in Washington, D.C. So you think about that. We didn't think about Uber or that sort of stuff when the iPhone rolled out in 2007, but you had an industry that was ripe for disruptive, like the taxi cab industry. I travel a decent amount. Previous to Uber, it was you call a taxi cab company, maybe they answer in the morning, you request a taxi, and you kind of beg and pray that they come and show up and take you to the airport. Transform that you're actually following them and you can see them in real time. So pretty unbelievable move there. And we're going to see a lot more movement and innovation from that perspective. The way we think about it too is, what inning are we in with artificial intelligence from an investment standpoint and from a life standpoint? The question becomes, are we in this kind of like first inning or second inning? And I would probably argue with this, to use a baseball game analogy, they haven't even played the national anthem yet. We're in the early innings. And a lot of the stocks that I just kind of talked about are some of the early beneficiaries of it. So what do I mean by that? NVIDIA, the first, I think it was $4 trillion stock out there. So the early beneficiaries have been NVIDIA and Taiwan Semiconductor, ASML, AMD. What do these folks do? They're making the chips that these companies need to do the computing and do the power. And that's kind of the first kind of movement or first wave of the beneficiaries of it. But this is going to play out in a lot of different ways. And I'll share with you some examples. The other way it's playing out is some of the provider companies, right? The application companies. So Microsoft coming out with an AI office tool that a lot of us will use. Alphabet or Google, when you're doing your searching now, you're seeing AI responses there. Amazon benefiting from their cloud and Alexa. A lot of these different companies kind of really benefiting from the AI. The other play on AI, which is really fascinating, is the stodgy old energy sector, energy companies. When oftentimes we think about AI or ChatGPT, we think about this great big app in the sky that's kind of out there in the sky. The reality is this is probably the most physically intensive technological infrastructure change we've ever had or ever experienced in our lives. This AI and this movement of AI and utilization of AI creates a tremendous need for computing, and you need vast data centers, huge data centers and huge racks of servers. This is tremendous gear. It requires power like we've never seen before in our lives, and that's why I bring it up. The power demand from AI that we're, again, in the early innings of it, is creating unprecedented demand for power, demand for energy, and we don't have a playbook to really understand what's going on. Over the last 20 years, demand for power in the United States, even though, population has grown, business has grown, has been flat. It's unbelievable. Demand for power in the United States has been flat. Reason for this is we've offshored a lot of manufacturing. Appliances that we use in our home have become more efficient. And because demand has been flat, there hasn't been a lot of focus on increasing energy aside from focus on carbon-free or green energy, right? We kind of got lulled in the sense of kind of like, okay, we're not going to need any energy demand is going to decline over time. And then the EV charging vehicle really freaked people out because that created a tremendous demand for electricity or power, but that was the canary in the coal mine versus AI. The challenge with the move to green energy is that wind and solar are not available 24/7. If it's not windy, you're not getting energy. If the sun's not shining, you're not creating energy. These AI tools, these data centers that are powering them, will need energy 24/7. The other challenge is the grid isn't reliable, right? The power lines, the power producing plants, they're probably on average 40 years of age. And for the past 20 years, permitting has been challenging. What I would say now is we're seeing innovation in the energy sector, which I think good for all of us, more energy, less expensive energy, and smart energy from that standpoint. Up until recently, nuclear energy was not profitable. But now we're starting to see a look back to nuclear energy, which checks a lot of the boxes. In fact, 3 Mile Island has opened up back up for business after being shut down for quite a period of time. What we're seeing as well, which is exciting from an economic standpoint, from a lifestyle standpoint, and from a market standpoint, is the technology companies really partnering with energy companies to try to figure out this solution. The other way it plays out as well is in companies and companies' earnings, which would be good for the stock. It could be insurance companies that can rely on artificial intelligence to do a lot of the grunt work, the computation as well, accounting firms, legal firms. So we think it'll create a lot more efficiency, a lot more scale, a lot more profitability for companies as well. So again, I just wanted to give you an example of how it's like, it's not just NVIDIA making the chips. This thing is going to play out over time in a lot of different sectors and a lot of different areas. The other spot I just want to is to close out here, another area which we've kind of forgotten about in a while, which has kind of popped back up. As I said earlier, the first half of this year, U.S. markets were up 6.25%. International markets, which have lagged U.S. markets over the past, 10, 12 years, are up 18.8%. And in our viewpoint, a lot of investors have probably been overweight international stocks. And again, going into this year with Trump winning the election and the tariff talk and American exceptionalism, people will be like, why would I own international stocks whenever? But again, the market reminds us when we kind of all harness in on this one concept or idea, we tend to get surprised. And again, international stocks up 18%. We can't guarantee anything in the market, but what we do think is that based on very good valuations in international stocks, priced less than US stocks, a lot of spending internationally as well. The NATO thing, again, a lot of this is policy driven. You're starting to see European nations start to invest tremendously in their defense and their defense spending. You're also seeing countries like Germany doing a lot of fiscal stimulus to get their economy going. And we've also seen a weakness in the dollar as well, which has benefited international stocks. Not to say the end all be all that, the international is going to beat America or US stocks are going to beat international, but in investing, one of the truisms that we know is you kind of want to hedge your bets. You want to make sure you own diversified asset classes. And in our minds, international is a diversifying asset class, and it's also an asset class maybe a lot of us don't own enough of, and could be poised for some good returns from that standpoint. I'm going to turn it back over to Micah to see if there were any closing comments, but for me, hopefully for you in the audience, 20 minutes went very quickly and a lot more stuff we can talk about. So I want to thank Mike and the team for allowing me to share with what Fidelity's been kind of thinking about the market and hopefully provide me insight. And he can certainly reach out to me for any follow-up questions. But Mike, I'll kick it back over to you.
Yeah, no, appreciate that, Jim, and appreciate all the information you provided on the markets. And it's this year has been, as you've mentioned, full of uncertainty. Markets certainly don't love uncertainty, but there's that's why diversification is so important. You touched upon a lot about the equity markets, and a lot of times within your 401k plans, if you're invested in any sort of target date funds, many times those target date funds are going to naturally own a combination of both U.S. equities and international equities. So you're able to naturally stay diversified. Anything on I know we spoke a lot on the equity markets, Jim. Anything on the fixed income markets that you want to share before we wrap up? That'd be my only sort of.
Yeah, no, absolutely. It's been, we are very, our quote from our bond team has been, Micah, if you don't like bonds now, maybe you'll never like bonds. You're getting a really, in a kind of diversified bond portfolio, you're getting an extremely attractive yield right now, which we view, so your starting point is way higher than it had been over the last, again, almost 20 years since 2008. Additionally, we don't make any predictions on what's going to happen with the Fed, but I think the overall market view has been we'll probably see a couple rate cuts, and rate cuts are good typically for bonds, which increase the value. So we don't want to make any prognostications, but we've had a good year to date in fixed income in bond funds. And based on where yields are, where we are from interest rates, again, we don't know what we don't know. We feel really good about bonds and the value that they offer for customers as well. 2022 was a year, it was kind of a weird year where usually stocks and bonds move in opposite directions. That one's where they moved in tandem, but we're starting again to see some negative correlation. So when the stocks are down, the bonds tend to do well. When the bonds are down, the stocks tend to do well. So that's kind of the other piece of the puzzle. Micah, thanks for reminding me about that. And as you said, in a target date fund or an allocation model, you're going to own a nice mix of all of those pieces.
Yeah, absolutely. Really appreciate that, Jim, and all the insight that you provided. And certainly, if anyone on the listening has any questions, feel free to send that our way. We'll be sure to get those questions answered. But as we sort of wrap up here, We want to remind you that we do have some tools and resources always available to help you. As part of your company's financial wellness program, you have access to your personal financial website. This is something specifically for you, and it can be used to track your overall financial situation. You can use it to organize your different accounts and see in one place things like your total net worth. You can put in your savings, your investments, any real estate you own. You can subtract any of your liabilities you have, such as your mortgages, student loans, credit cards, etc. There are also some great interactive calculators you can use to see if you're on track for retirement or any other goals you have. You're able to keep track of spending, create a budget, and run many different types of reports. So this is a great tool. We encourage you to use it, and you can scan the QR code here to access that website. The other tool that we wanted to share with you is your investment risk score. So by scanning this QR code here, it'll take you to a 5-minute risk tolerance questionnaire. This is a questionnaire that will work on pinpointing sort of what you're willing to risk for potential gains and give you a score between 0 and 100 depending on your risk tolerance. What we're able to do from there is create a risk score for your current 401k account, and we can then compare it to make sure that your portfolio matches with your personal risk. So again, if you scan that QR code here, that will take you to that questionnaire. And finally here, if you'd like to connect with us directly, you can schedule a 30-minute one-on-one call with one of our advisors by going to this QR code and get sort of general basic financial questions answered. Looking ahead to the next couple months of the year, as summer progresses, next month on Thursday, October 21st, same time, 11:30, we're going to talk about year-end financial planning reminders. We know it's only August, but again, the end of the year will be fast approaching, and we want to give you all plenty of time to execute some of the things that we're going to discuss. So that will be next month's webinar on August 21st. On September 18th, we're going to start talking about getting prepared for open enrollment and how that fits into your overall financial picture. And then come October, similar to what we did today, we'll discuss the investment markets over the prior quarter. So that's what the next few months looks like. Really appreciate everyone taking the time for joining us today. Jim, again, thank you for taking time to be here. We provide
for having me.
Very, very helpful. So thank you so much
Awesome.
for being here. And that we're going to wrap up there. So again, feel free to reach out with any additional questions. Have a great rest of the week, and we'll see you all next month. So take care.